Welcome back to Eurodollar University. My name is Emil Kalinowski. I'm joined by Jeff Snider, the head of global research for Alhambra Investments. In episode 168, we presented to you a case that said the central bank, the Federal Reserve, the European Central Bank, does not affect bond yields. They do not influence bond yields with their QE policies based on the number of purchases they make. But there are people that will say that it is rigged, that we're looking at the wrong thing, that we're looking at the flow of purchases versus the stock of purchases. Jeff, what is the complaint? What is the response from some members of our audience regarding our argument?
Yeah, Emil, as you said, we often use the bond market yield curve and things like that to calibrate our expectations, to gain a lot of insight and information into what's going on in the financial marketplace. And people don't like what we're saying. And not only that, they say, well, you're not looking at the market, you're looking at the Fed's purchases, right? So when you say that low interest rates are a reflection of low growth and inflation expectations going lower and lower and lower over time, what they're saying is, no, that's just the Fed buying more and more bonds. Therefore, the signal that you're relying on to set your expectations and make forecasts and predictions has been spoiled by all of these bond purchases. The Fed has screwed up the bond market because the Fed has said, we want interest rates to be low, and we're buying a hell of a lot of bonds. Therefore, interest rates are low, must be because we bought a hell of a lot of bonds. We have this perfect correlation, so you can't rely on the bond market or interest rates because they've been completely upended by this massive, megalithic purchase programs from the Federal Reserve, ECB, Bank of Japan, whatever central bank it is. They have completely spoiled the signal.
Now let's just do a little example for the audience, Jeff. Okay, maybe they haven't seen 168. We'll do an example for the flow argument by looking at this chart that goes from 2008 to 2011. That shows the balance sheet size. I believe these are Treasury securities, not the balance sheet size, but Treasury securities held by the Federal Reserve. And then we've got the 10-year and 30-year yields here. And Jeff, you just jump in. In 2008, the Fed wasn't buying, but yields were falling and prices were rising. 2009, the Fed was buying, yields were rising and prices were falling. 2010, no buying, yields falling, prices rising. 2011, Fed was buying, yields were rising and prices were falling.
It's not exactly the theory, is it? Right. And again, from the public's perspective, people who don't follow this stuff closely, the theory sounds entirely plausible, if not likely, right? You have this large non-economic actor that comes into the marketplace and starts buying up these assets. Why wouldn't it be able to influence prices? But as you're saying, Emil, it only takes 5 seconds of work to disabuse you of these notions, because as much as the theory sounds plausible, in practice, it works out at best, not really any detectable effect. But in reality, it's almost always the opposite, right? As you pointed out, especially in the early aftermath of the crisis period, you have it where it's almost exactly opposite. The Fed starts buying bonds and yields rise. They're supposed to be falling here. Why are they rising? And the reason how we reconcile all this is not via QE. The QE is really irrelevant. What we're really saying is that, as Irving Fisher identified more than a century ago, longer-term bond yields are a combination of growth and inflation expectations. That's it, full stop. It doesn't matter how many bonds the Fed buys or how much flow in any particular time period. The market is trading on growth and inflation expectations. And so the way you actually look at that, especially in 2009, the early part of 2009, the bond market was actually being very complimentary of QE. It was saying, look, this stuff might actually work. We're predicting higher growth and higher inflation maybe because of bond buying, maybe just because the crisis is over, but whatever it is, this was a good thing. The market was saying there's a combination of positives here that the market sees as higher growth and higher inflation. That's really, the whole theory is completely upside down from beginning to end.
And you're very complimentary to us, Jeff, by saying it only takes 5 seconds. It actually took us 21 minutes, where we went from 2008 to 2020, ladies and gentlemen. It took us 21 minutes to review that history. We're just going to go.
That's because there's so many QEs. They have to repeat them all the time because they work so well, right? So we had to go through all of the QEs in order to, look, all of these QEs, we did QT, we did Europe, we did all of these other
Mm-hmm.
examples, and every single one shows that the flow argument, the level of purchases or the pace of purchases in a particular period is complete and utter bunk. It's just, it's the Fed does not influence bond yields. Bond yields are growth and inflation expectations.
Au contraire, my friend, because I'm showing another graph now. And what does this graph show? It shows major central bank assets versus global stock and bond market value, Jeff. And I'm looking at this just quickly. If you just quickly look at it, the correlation is there, and therefore the causation is there. Bond buying, central bank activity leads to higher stock and bond market values. True.
Au contraire, my friend, because no, you're committing the first fallacy. You're committing to the first fallacy of statistics, which is correlation does not always imply causation. In fact, it rarely implies causation. So yes, we do see that central bank around the world, we do see that central bank bond purchases largely, roughly corresponds with the increase in value and holdings and increase of prices of those bonds. But does one thing cause the other? Is it that the rising prices of bonds are caused by the central bank purchases? Or are those two things just mere coincidence? And as it turns out, those two things are mere coincidence. And you don't have to take my word for it. You can look at charts, you can look at any number of data indications, but you can also read what these Federal Reserve policymakers in particular have said about it. And as I quoted in the article, Richard Fisher, who's not really well known as the most astute of the FOMC members, he's the emptiest of the empty suits, in 2011 was kind of wondering why the Fed was buying all of these bonds that the market was already buying anyway, because that's not really what central banks are supposed to do. And what he was really saying in terms of our discussion here is, we're buying bonds the market's already buying, so our bond buying is coincident to the market's bond buying. So the prices are not really being set by our bond buying. The prices are already being set by the market's bond buying, not ours. We're just doing the same things at the same time because, as he didn't ever figure out, both things are reactions to the same thing. We have exogenous money shock that leads everybody to reduce their growth and inflation expectations in the bond market, which means they want to own safe and liquid assets. They start buying, the private market starts buying these safe and liquid assets. Yields fall. The Federal Reserve or ECB or whatever central bank comes along and says, hey, we're starting to get the idea that the money system's not really good here. We probably should make a policy change so that we can try to stop these deflationary outcomes from proliferating. Well, we're already at the zero lower bound or we're near it. So we're going to buy bonds because our monetary policy revolves entirely around bank reserves. And the only way we can increase bank reserves that nobody needs is by buying bonds. So the private market's already buying bonds. Then along comes the Federal Reserve or the other central banks to also buy bonds at nearly the same time. It's usually the private market, then the Fed. And it's not that the Fed is raising the price of bonds. The Fed is just doing the same thing the market has already done, because both things are correlating to what is the actual cause, which is an exogenous monetary shock.
Let me backtrack a couple of spots here, Jeff. I'll read Mr. Fisher's quote, Dallas Fed Richard Fisher. Here we go. Quote, in summary, I want to mention that, as I said earlier, most of these variations that have been suggested are very un-Bagehot-like. And what I mean by that is twisting entails purchasing, this is the key part, purchasing assets that investors are fleeing toward, not assets that they are fleeing from. Thank you very much, Jeff, for reminding us that. And now I'm going to read a quote from you, and I want you to help define one of the terms here. Quote, during a period of tight money, we would expect that the prices of safe and liquid instruments would rise at nearly the same time central banks respond in their predictable way to the same tight money condition. In a world of exogenous money, like the Eurodollar system, the one does not cause the other. Rather, this is the key, both are reactions to the same thing, the exogenous money. Jeff, I've been practicing saying exogenous. When I first read it, I got to exogenous and then I gave up. What is exogenous money? What does that mean?
We're just talking about a system that exists outside the ability of the Federal Reserve to control. It's a system of money that's external, another word for exogenous, external to the perspective of not just the Fed, but the United States in general, because The Eurodollar, as we talked about at length in the previous segments, is about offshore money. It's outside money. It's money that's not really part of the US. I mean, it flows inside and out, but it's really money creation that takes place outside. So it's an exogenous factor to what the Federal Reserve considers its mandate, which is the United States economy and the United States banking system. So if we have a problem outside of the Federal Reserve's control, thinking of Robert Russell's great quote from 1984, these new networks of interbank relations outside beyond the control of the Federal Reserve, this exogenous money experiences a spasm that causes the private market to react to this deflationary spasm, tight money spasm, by wanting to own a lot of safe and liquid instruments. And by owning a lot of safe and liquid instruments and by prioritizing safe and liquid instruments, that's also another way of saying we don't think growth and inflation is going to be very good for a probably long time because we're only going to own safe and liquid instruments because we think growth and inflation isn't going to be good because of tight money. So you have the private bond market already reacting to this outside external monetary spasm. And once it goes far enough, because the Federal Reserve and monetary policymakers they're stuck in denial for a very long period of time until they no longer can deny what's going on. Eventually, they have to come around because at some point it becomes undeniable, this exogenous monetary spasm. And the Fed will, as it did in 2008, it will react first by reducing the federal funds target, which doesn't help. And eventually you get down to the zero lower bound. What else can you do? You're the Fed, you've lowered rates as far as they'll go. Not that it has helped any because the bond market has already lowered rates. You have to start increasing bank reserves because that's the way you try to tell the public you're being accommodative, to try to sell them on positive expectations is by creating bank reserves. Nobody needs bank reserves, but it's for the public consumption. It's for you to be able to say to the public, I'm doing something that you're supposed to believe is helpful. And the only way to create bank reserves and to raise the systemic level of bank reserves is to buy assets. So you have the Fed starting to buy the same assets the market has already bought in by the bushel, and it's not one causing the other. Both are reacting to the same thing, this exogenous monetary spasm that looks very coincidental because it is coincidental.
I'm going to read another good quote by you and then go back to the graph that we raised just a moment ago, and that'll be it for me, Jeff. Here we go. The Fed's balance sheet is actually the same thing, the same sort of indication as falling yields, both adding up to negative deflationary connotations. When the central bank's balance sheet goes up, not only is this not the cause of rising bond prices, the QEs, again, are a reaction to the same problem, which further corroborates why and how bond yields have already sunk. Just a great summary I wanted to.
I think that's an important point too, because, and it's one that people who believe in the Fed's power really don't like, because what we're saying is that when the Fed raises its level of bank reserves, that's another coincident and consistent warning with all of these other deflationary measures we see. Because if both are reacting to the same exogenous monetary spasm, and they are, then when the Fed raises its level of bank reserves, what that tells us is that there must be a real problem, that the Fed, the last people in the room who actually understand what's going on, if they can see this deflationary problem that is causing them to think they need to raise the level of bank reserves by buying bonds, then it must be a really serious situation if even these people can see it. And so the Fed's balance sheet and the level of bank reserves, that's not money printing. It's another deflationary warning. It tells us that the situation has gone so far, the Fed starts to do what the private market has already been doing. And so, again, going back to Richard Fisher, they're buying bonds the market has already fleed towards in huge numbers. And that's what drives prices of these instruments, not the Fed's bond buying. The Fed's bond buying is simply just a coincident and consistent indication to why the private market is buying bonds to begin with. I think we should end this segment on what you always point out in this position. And I'll let you talk about it because, yes, sure, the Fed buys U.S. treasuries, but do they buy U.S. dollars? Do they buy Eurodollar futures? No. We're not just talking about U.S. treasuries or the yield curve here. The yield curve, like the Fed's balance sheet, are part of a comprehensive picture that we can put together that tells us this same thing. And you go through it, Emil, because this is one thing you always talk about, a good thing that you always talk about.
I would like to, Jeff, but you've stolen my thunder. And ladies and gentlemen,
sorry about that.
No, not what you just said. But ladies and gentlemen, you perceive Jeff as this robot, maybe a cyborg, just diving into the transcripts, and he doesn't have any fun, and he never reads any fiction. Let me just quote this very fervent, passionate sentence from Jeff. The final bucket of nails in the stock idea gets hammered home repeatedly by what my brashly astute, I can't read it without blushing, brashly astute co-host Emil Kalinowski lustily points out time and again. This being the whole rest of the bond market, Eurodollar futures, swap spreads, the dollar exchange value. This is the first time you put the word lust in your writing. Brash,
I mean,
astute,
who does not
lust
over the bond market's deflationary signals, right? I mean, if the word lustily doesn't apply to this context, it applies nowhere, sir.
I'm going to ask the editor to hew down my ears and my face, which must be red as a beet. Well, to your point, Jeff, we
okay, look, yeah. I think the final takeaway is this. You don't like what the bond market is saying, fine. You know, the Fed is tainted to rig the bond market, sure. But it hasn't tainted everything else. All of these other indications that are telling us in real time, in historically validated circumstances, what is actually going on that is consistent with the low growth and inflation interpretation of bond yields. The Fed has not rigged the entire bond market. It hasn't even rigged part of it, but it certainly has not rigged the entire bond market. And the entire bond market consistently tells you the stock argument is equally bunk as the flow argument.
Thank you very much, Jeff. I had a great time, great week. Hope you had a nice Thanksgiving. And anything else? Anything you're looking forward to? Oh, yes, of course. There's a Monday night football game between the New England Patriots and the Buffalo Bills. Holy cow. And there's two of them coming up.
Yeah.
Two back in almost back to back almost. Excellent. That'll be exciting.
Look forward to. Absolutely.
What our foreign watchers and viewers complain to me on Twitter, and they say, don't call it football, call it hand-egg ball. Hand-egg ball.
I think that would be more accurate. I mean, they have a case here because you don't really use your foot much in football, at least in American football. So they do have a point there, but you know, us Americans like to think, well, this is what it is, so this is what we're going to call it.
That's right. All right, Jeff, thank you very much. I'll talk to you again next week.
Okay, take care, Emil.